Hello and welcome back to the Tax Roundup. And you know that saying there's no rest for the wicked? Well, accountants must have been very wicked in a past life because there is a lot on and the pace of change is continuing unrelentless. This month we're going to take a quick look at a couple of very important cases. The first one on vivir case, looking at dividend access shares and access to the CGT small business concessions. We're also looking at the GST implications of agency relationships and where that all went wrong for a property manager. Mike's going to take us through some very important pieces of legislation that have come through on earnout arrangements, those long-awaited reforms to earnout arrangements. And the same legislation also contains the rules on the 10% withholding tax for sale of property by non-residents. But first up, Ray's going to take us through a new and very frightening data matching program initiated by the ATO.
Now, as we know, the ATO are doing a lot of data matching the last couple of years, and they're continuing to ramp that up. They now have a new program that they've issued a Gazette notice about. This is about data matching for records going back to the 20th of September 1985. And you've guessed it, CGT is a main focus of this, but it's not the sole focus. So from 20th September 1985 until the 30th of June 2017, they are looking to get records for every single one of those years. They're expecting about 31 million records for each of the years, which would be comprised of approximately 30 million from the Revenue and Land Titles offices, and another 1 million per year from the rental board agencies and associations. So what they're trying to look at is not only the CGT implications, but also possible rental trends. And they're doing this as part of an exercise to identify where there may be risks or trends in relation to non-compliance, and also to help them identify a new compliance program going forward, using all that information to identify the gaps and hopefully stop them. So we'll see what happens when they've had a chance to analyse that information. No doubt there will be further information to come from them.
In cases this month, Mike is going to take you through that vivir case, and it's important for clients who have different classes of shares. Across to you, Mike.
Now, just before Christmas, we had the federal court release a decision in a highly anticipated case dealing with the application of the small business CGT concessions when you have a company involved in a situation that has dividend access shares. Now, this has been an issue that has caused a lot of problems over the years. The ATO's long-standing view has been that the presence of dividend access shares or other different classes of shares can cause very significant problems when it comes to applying the small business CGT concessions, both in passing the basic conditions and also being able to access things like the retirement exemption and the 15-year exemption. Now, this case, the vivir case, it was originally heard by the AAT earlier in 2015, with the tribunal finding in favour of the taxpayer, which was great, and I guess in a lot of cases was a bit of a surprise to a lot of people. The case then jumped into the full federal court, and the full federal court again found for the taxpayer. Now, this goes completely against the ATO's long-standing view on this issue, which is why it's been so eagerly anticipated. Now, there's a couple of things to remember for this situation. Now, first, we just think about the facts. We had a company selling shares in another company. Now, to access the small business CGT concessions, when shares are being sold, there's a couple of extra conditions that need to be met. In this case, it was the 90% test. Now, we won't go through the details of that test today, but what you need to do is be able to identify some CGT concession stakeholders. Now, to do that, you need to find someone, at least one person, who has rights to at least 20% of voting power, dividends, and capital distributions as well. Now, the issue that the ATO has had for many years is that if you've got some dividend access shares or some other different classes of shares, and the directors are able to decide today to pay a dividend to the ordinary shareholders and tomorrow to pay a dividend to the dividend access shareholders, then that can cause major problems in passing that test and identifying a CGT concession stakeholder. What the full federal court found here was, yes, there was a dividend access share on issue, and if you applied the ATO's argument, then yes, that would have caused a failure of the small business CGT concessions. But what the full federal court said was, when we're applying the dividend test says if a dividend was paid just before the CGT event, who would be entitled to those dividends? And we work out a percentage from there. Now, in this case, the full federal court found that the dividend access shareholder would not have been entitled to receive any dividends had a dividend been paid just before the CGT event. Now, this was due partly to the rights that were attached to those shares, partly due to the wording of the company's constitution, but also because there was a resolution that had been made a number of years ago which restricted the ability of that shareholder to receive dividends in the absence of an additional resolution being passed by the company. Now, that additional resolution wasn't passed just before the CGT event, so if a dividend had been paid, the court said, well, it could only have been paid to the ordinary shareholders. As a result, you could identify some CGT concession stakeholders and the test could be passed. Now, that's a great result for those taxpayers. They were able to access the concessions and pay little or no tax on the sale of some business assets. Where we need to be really careful with this is that case focused very much so on the wording of the company's constitution, the resolutions that have been made in relation to the shares, the rights that were attached to those shares as well. It's not hard to think of situations where having different classes of shares will still cause major problems under the small business CGT concessions. So while it's a positive step, I guess, for those of us who come across this issue for our clients, we still need to be really careful, and we may still need to think of other alternatives to get around this problem rather than relying on the rights or the restrictions attached to shares. Maybe we need to think about getting rid of those dividend access shares. Maybe we need to think about issuing new shares to make sure everyone's got one of each share class of shares. So there might still be things we need to do from a practical point of view to help our clients access small business CGT concessions. The other thing is we need to think about this well before a potential transaction. If these issues are identified after a CGT event has been triggered, it may well be too late to be able to fix the problem. So really good to be aware of this issue, particularly if you have clients operating through company structures where you know that those companies have different classes of shares. This is also relevant for unit trusts, which have different classes of units. It's a positive step, but we just need to be careful not getting too carried away. We need to still look at the detail and make sure exactly what the position would be if the CGT event happened now.
Now across to Ray for the Crown Estates case, which looks at GST implications for agency relationships.
Now we have another AAT case in relation to GST and agency relationships. This is one of those areas that just causes an awful lot of confusion. So the key thing to remember is that if there's an agency relationship in place for GST purposes, even though the agent may be organising everything, it's the principal or the owner, for example, of the property in this case, that is the one that could potentially claim the input tax credits for the services provided by the third party, which the agent has arranged. In this particular case, Crown Estates, it was dealing with a property manager that was claiming input tax credits on services not only for themselves but also on things that they had organised for their own clients, the owners of the property. And unfortunately for them, they didn't quite get it right. So they were claiming input tax credits on services from third parties that they had arranged for their own clients, the principals, the owners of the properties. Unfortunately, when agency relations are looked at, you've really got to make sure you get it right. When there's an agency relationship, even though the agent may be organising everything, it's from a GST perspective, it's still a transaction between the principal and that third party providing the services, even though there may be no direct contact between the principal and the third party. The agent may be organising everything, but it's not the agent's right to claim the input tax credits because the services are going effectively through the agent to the principal. Unfortunately, in this particular case, not only do they get it wrong for several years in a row, but they now are facing not only the GST cost, but also the penalties and interest. So once again, time to take a step back, look at this. Has it all been considered? And is this genuinely an agency relationship, or are they acting as principal?
Across to Mike now, who's going to take you through the Tax and Superannuation Law Amendment Bill, number 6.
Now, another one in the long line of things that have been fairly eagerly awaited by lots of practitioners is the bill that was introduced to Parliament just before Christmas dealing with the changes to the rules around earnout arrangements, so capital gains tax when earnout arrangements are involved. Now, again, as a lot of people would be aware, this has been a confusing issue going back many years since the ATO released a draft ruling back in 2007, which changed the way a lot of people thought earnouts would be taxed. Now, since that time, we've had government announce that there would be changes to the rules, but it's been a long time coming. We're finally almost there. So the bill that's before Parliament introduces basically a brand new system of taxing earnout arrangements. It will apply technically from the 24th of April 2015. Now, there may well be some people who had events that occurred before that time, which was subject to an earnout arrangement. There are some transitional rules that might help you apply these new rules in those cases, but you need to look at the detail. The explanatory memorandum has some examples around who can and can't qualify for applying the new rules to older events. Now, I guess in a nutshell, the first thing we need to look at when we have clients who are selling a business or selling assets under an earnout arrangement is, does it actually qualify for the new rules? Because there may well be some situations that just don't qualify. There's a list of conditions that need to be met. You need to work through those to see whether these new rules are available. If the new rules are available, then basically what happens is we apply a look-through approach to taxing both parties. So the vendor will be taxed on the amount that they've received up front, so the fixed consideration. As they become entitled to further consideration in future, if that is actually the case, then you take that number and you put it back in your original CGT calculation. So you're simply increasing the capital proceeds from the original event. That may well require you to go back and amend prior year tax returns to reflect an increased capital gain. In some cases, your client may actually be going from a capital loss situation to a capital gain situation. Again, amendments may be required to do that. Now, from the purchaser's point of view, pretty straightforward really. Every amount that they pay under that earnout arrangement just increases the cost base of the assets that they've acquired. So if we compare that to the old approach, the ATO's old approach in the draft ruling, much more sensible approach. It's a better reflection of the underlying commercial characteristics of the transaction, and it should be a lot easier for people to work through this in practice. Now, that's not to say that this isn't without difficulty, and when you work through this in practice, you'll see that particularly where someone is selling assets under an earnout arrangement and they could qualify for the small business CGT concessions, there's still a bit of difficulty in how you apply the concessions in a case like this. Now, fortunately, the rules will introduce some changes to make the small business concessions work better when it looks at earnout arrangements, so extending time periods for making decisions, for making payments. So tweaking the rules a little bit just so it fits a little bit better with this new regime. So still a bit to get your head around, but it should be more workable and it should produce more sensible outcomes for earnout arrangements in the future. Now, the other thing just to quickly mention is that that bill containing the earnout arrangement rules also contains the brand new withholding tax for when a non-resident sells certain Australian assets from the 1st of July 2016 onwards. So brand new set of rules, not coming in until 1 July 2016, but what it does, it imposes an obligation on the purchaser to pay 10% of basically the purchase price to the ATO as a form of non-final withholding tax. This will be applicable where the non-resident is selling land and buildings in Australia, certain mining rights in Australia. It might also include the sale of shares of companies and units in trusts where those companies or trusts own land and buildings and other real property type rights in Australia. So it's an obligation on the purchaser. They're the ones who have to pay the amount to the ATO, 10% non-final withholding tax. The non-resident still has to lodge an Australian tax return. They put in the capital gain or the capital loss, and they get a credit for the tax that's been withheld effectively on their behalf. So again, something to be aware of. It's something that won't kick in for a little bit longer yet. Assuming the bill passes through Parliament, start date of that is 1 July 2016.
And that's the tax roundup for this month. It's going to be a huge year of change and reform. If you want to keep up to date with everything that's going on and you're not a member of Knowledge Shoppers yet, then give us a call on 1800 800 232 and we'll show you how we can make life in public practice easier for you. See you next month.